One of the biggest growth areas in the investment world over the past few years has been the private markets and in particular private credit. I have Simon from Avari today with me. Very lucky to have you. Thank you for joining me.
Thanks, Pete. Very happy to be here.
What's happening in private credit? Give us the lowdown.
Yeah, I mean, there's a lot happening. There's a few newspaper articles today that you might have seen. I think the strong tailwinds in private credit are still definitely there. I guess there has been some hiccups in the high-rise construction space this year, which we've been lucky to avoid. But I think probably the big themes are undersupply of housing has really put a floor under the whole market. So that's why we really like this market.
Let's start from the top because I understand it, but maybe for people watching that don't understand why private credit has grown so much. What happened structurally with the banks and the way they change their lending for private lenders to come in and start to take a part of that market?
Yeah, sure. So people probably think that private credit's a new thing, but it's really not. It's been around La Trobe's been around 50 to 53 years now. So it's not a new idea. It's probably just gained mainstream appeal in the last probably 5-6 years, I would say. And I think the reason for that is it's just been more product available, more funds like us coming along, making it more easy for people to access. But I think also just the move away from probably traditional bonds more towards private markets, and seeing that in equities as well, more from active to passive, and then people putting a larger chunk of their portfolio into alternative assets, which now some, depends who you're talking to, but some people say that accounts for 20% of the portfolio.
Did the banks actually walk away from a whole heap of clients and say, you're on your own, go and find your own funding? Or have they just not taken on more business? What kind of happened in that banking space?
Yeah, right. So the big thing in the banking space was the Basel III requirements after the GFC. So basically they said that any development style loans, so particularly non-servicing loans, they have to hold a higher level of capital behind those loans than they do for a residential mortgage. So it just became a lot more profitable for the banks to do residential mortgages than to do commercial, particularly development lending. So banks are really only concerned about serviceability. So probably the very, very, very simple, the biggest difference between a bank loan and a private credit loan is that banks only look at serviceability. Private credit loan, a private loan, they can do an asset lend. So they can say, they can take a view on that asset. They can say, this building we're in here, we think this is a great building. We're taking 65% LVR. We don't think the building's going to fall by 35% in the next 12 months, and we can lend on that basis. There might not be serviceability, and maybe there's some value add component that they're going to do. Whereas the banks, they just say, how are you going to pay your bills next month? So then we can pay our bondholders and things like that, because banks are a leveraged financial instrument. So they're borrowing money on one side, lending it out on the other side. So they need that constant cash flow.
Yep.
Whereas the private markets can take a bit of a different approach. So it just means that private markets can be a little bit more flexible and offer that solution that the banks can't. So
let's break down some misconceptions.
Yep.
Private credit is a big, broad brush that can involve a lot of things. You can lend to construction, you can lend to land, you can lend residual stock, you can lend to different industries. Where does Avari play, and what is your kind of niche?
Yeah, sure. Great question. So, I'd say most people, when you say, so we're in real estate private credit, so probably the two biggest distinctions is either, so private credit's pretty all-encompassing term. There's probably three broad categories. So there's real estate, which is what we're in. There's corporate, so lending to individual companies. And then there's asset-backed lending, so maybe like receivables, invoice financing, car loans, that sort of thing, where there is sort of an asset behind there. And it probably goes corporate is the highest risk, then asset-backed, and then real estate. So we definitely are in the real estate space. So we only do real estate. We're a debt and equity investor. So we also do buy office buildings, industrial, resi. We're buying caravan parks at the moment. So we do quite a bit in the real estate space. But on the credit side, we purely focus on real estate first mortgage. And our niche in that, or it's not really our niche, we don't want to pigeonhole ourselves, but we definitely have been focused a lot in the land subdivision space rather than the high-rise construction space.
Run me through how hard it is to bring a residential block of land to market in a major metro city like Sydney or Melbourne or Brisbane.
Yep.
The process, what the developer goes through, and how you work with them as a funding partner.
Yeah, definitely. So, I mean, a lot of people have made a lot of money by land banking out, particularly out near the new airport. You've probably heard of some amazing stories of people making a lot of money. But you need serious money to be able to hold on to those. You might have had to buy the land 10, 15 years ago when it was literally farming land, and hope that one day it was going to get rezoned, which it now has. So if you're lucky enough to do that, or what we're generally dealing with is a developer who might have put an option down on a piece of land in that area 5, 10 years ago, that option is now in the money. So that's worth a lot more than what they paid for it, and they need the money to actually buy it. So they've got to pay off they've got to pay the vendor. So that's where we'll come in. So that would be what we call a land loan. Generally, that land will have, so it's literally a piece of farming land at the moment, but it's got a DA and it's got council approval to turn it into a land subdivision. Oftentimes, even once you've got a DA, it'll take you about 12 months before you're actually ready to do anything. So that's that land phase. We're generally lending there at sort of 50% LVR, and it's pretty straightforward because there's not a whole lot that can go wrong. It's literally a piece of land. It's got a DA. Oftentimes they say, I want to rework this DA to get in a few more. I want to reduce the size of the lot so I can get in a few more houses, or I want to apply for some special dispensation, maybe put in some student accommodation or something like that where I can get in some more FSR. So generally, that's a 12-month process, and we really like that because there's not a lot that can go wrong.
There's a lot of time, right? People think that these developers go in and turn something around and they make all this money on the back end, but they don't see the pain and the time. And time is money, particularly when interest rates are high.
Exactly. Yeah.
So you have to go and secure it. You have to then fund it. You then have to rework the planning. You then have to put in the roads and the infrastructure.
Exactly.
What's that looking like in the market at the moment?
Yeah, so that's probably that's the next stage. So that would be when we call a construction phase. Most people would think we're actually building the end houses. But when we're doing construction in a land subdivision, all that we're funding is the roads and the pipes. So literally roads, sewer, water, and electricity. That generally costs about, on average, $100,000 per lot. So each block of land that they're selling, you've got to spend about $100K per lot. So that does add up. That's a fair bit of money that you've got to outlay. So generally, we'll be funding that for them. That might be another 12 months. So you've got initial 12 months, you've got then another 12 months of construction where the developer's not getting any income from that asset. So that interest is accruing in the back. So that's what we have to be very wary of and make sure that we understand the timelines. Because if that gets stretched out too far, that's when we could be in, our LVR could be, we think it's 60, but all of a sudden it's 80. And that's a situation we don't want to be in. And then once you move into a construction phase, we would have a pre-sales requirement. So they'd need to have probably 30% pre-sales before we'd actually allow them to start the construction. And then during that construction phase, they continue selling them. Once it's completed, then those pre-sales will all settle on day one, and then they'll either roll that into what we call a residual stock facility, where they can hold those completed lots and gradually sell them down, so they're not dumping them all onto the market at one go, or they might refinance to a bank, because that's a very, very low risk loan as a residual stock loan. It could be completed apartments, or it could be completed. We have some completed apartments in our portfolio. We also have completed land lots, and all lenders love those because there's zero.
There's certainty there, right? It's finished product.
It's finished product. You can walk in and buy it off the shelf. It's pretty straightforward.
Is development getting harder or easier?
I would say it's definitely getting harder. Yeah, I mean the planning is more convoluted. Particularly around the environmental side of things. So the amount of another point for the developers, the amount of consultants and things that they have to spend money on. Particularly around the environmental side of things, flooding risk, fire risk, all that sort of thing. it really does add up. So that's definitely getting harder. And then you got land taxes going up generally around the country as well.
So you've basically got government making things tougher and tougher.
Yep.
And then you have interest rates that are higher, so your funding is becoming more expensive. And for a developer, are there particular types of developments that are maybe easier than others, or is it tough across the board?
Yeah, it's a good one. I think it's probably tough across the board. I mean, the main ones we see are in the land subdivision space. I mean, the high-rise construction space, obviously, there was a big one that was in the paper today. A Melbourne developer went under halfway through a big construction program. That's why we try and stay away from the high-rise construction space, because something does go wrong halfway through, it's very difficult to get out of that, and oftentimes you even have to knock the building down to actually sell it, which seems crazy, but that's sort of the market. So I mean, I think we think the land subdivision space is just a safer play at the moment. There's obviously a shortage of houses nationally. I don't think anyone would disagree with that now, whereas a couple of years ago people were umming and ahhing whether that was true or not. I think now it's universally accepted. We think the land subdivision space is definitely the safer play at the moment, but
as a lender.
Yeah. And I suppose from a developer as well, like that's where we see, we don't want to go into a loan where we think the developer's going to lose money, because that means our LVR goes from 60 to 100 very quickly. That's, I would say, the land subdivision space for sure.
Now, that's with your lender hat on.
Yep.
But you're also an investor, an equity investor. How's that market looking? Are there deals in the market? Are there particular assets that are becoming more attractive? How active are you guys?
Yep. So we used to do, our business started off, we used to do residential development ourselves. So that's how the business started. We actually just finished our last resi project in Port Melbourne, which was a 14-storey, pretty high-end apartment project. And I think we've got 3 or 4 of those still to sell. So that's the last time we're going to do high-rise construction, because it's just a nightmare. So many things that can go wrong. That program went on for probably 2 or 3 years longer than we thought it was going to. So that was very hard work, and we kind of probably learned some lessons there. And we're probably a better fund manager than we are a developer. We've also done office. We've done quite a few offices in the past. Luckily, we've sold a few of those.
How's the office market? I mean, what's the vibe? Because the beginning of the year was all about, office write-downs.
Yep.
People aren't using offices as much. These things aren't worth as much as what they were.
Yep.
We didn't really have a systemic issue. Is there value in office now, or is it still difficult as an asset class?
It's still difficult, and there's definitely a dispergence between the A grade and B grade stuff. So we have a couple of B grade assets. If you're looking at where we are down here, anywhere that's got water views basically is an A grade building. All those buildings are full and the rents are actually going up. The B grade stuff is harder at the moment because if you think about it, if rents are going down, I've got the opportunity to move from something that doesn't have water views to something that does have water views. I'm going to take that opportunity, and that's what everyone's doing. So there's more vacancy in the B grade stock, but I think the work from home is starting to come back to normal. People are getting back to the city. You look around the streets; it's busier and busier every day. So I think there is value, but I think the market has definitely shifted substantially down. So it's probably around about 20% down across the board.
Is that an opportunity to buy?
Yeah, I mean it probably is. It probably is, and I know there are some opportunistic groups like us out there who are buying up office at the moment, and you are getting pretty good yields. Like you can get sometimes in Canberra. There was a deal done recently at 9% cap rate, so that's a pretty good return for an office, and you're just sitting there collecting the rent. I would say there probably is. We're not looking at office right now. Not to say that we won't maybe next year. Industrial's been a really strong play for us over the last couple of years, so we've focused a lot on that last mile logistics space. So that's sort of smaller warehouses, I guess you'd call them.
How small is small for you guys? Is it like a complex or purpose-built industrial?
No, more like a single factory, I suppose you'd call it, like 5,000 square meters, something like that. But mostly in the sort of areas that are 10, 20 k's from the CBD, where not the big Amazon distribution centres. and they're probably not major tenants that you would have ever heard of, but sometimes they're, Amazon now, because especially with delivery times getting faster and faster, they need the big distribution centre out west, and then they need a smaller one closer to the city. And we like those smaller ones that are basically surrounded. Think of like Artarmon or Botany. Those are probably 2 areas in Sydney that you'd be most familiar with. Surrounded by residential, they might even get rezoned to residential at some point. So you've got multiple sort of exit options. So we've had some really good success in that space.
Now, you and I have known each other for a while.
Yep.
And, as a investment professional, your career has matured and grown from public markets to private.
Yep.
A lot of the conversations that you're talking about now are not really credit or equity, they're real estate.
Yeah, exactly.
Right? The journey. What's that journey been like for you, and what have you kind of learnt along that way as an investor?
Yeah, I suppose for my portfolio, I started off my career in equity derivatives at Macquarie Bank. And that was pretty high risk sort of stuff. So leveraged instruments, trading, and a lot of it was public market equities. So top 200 sort of stuff. Used to do a lot of trading, lost a lot of money. I wasn't very good at trading, which I've definitely learned. I'm not a great trader, but I'm pretty good at picking themes. So where the long term direction's going. So now I just use ETFs for my portfolio personally and private credit. But I've also had some good success in direct real estate as well.
Well, it's psychologically tempting, right? Because I started off in public too, but you can have your theme, you can have your thesis, you can think intellectually about something, but then you can also sell at a click of a button. It's in your pocket, it's on your screen.
Yeah.
And the beauty about real estate, whether it's credit or equity, is that once you're in, and you're kind of forced to hold.
Yeah.
And then there's a beauty to that, because even the best stock investors, even the best public market guys are the buy and hold.
Yeah, exactly. Yeah. And that's what I found in my personal portfolio. Often I'd buy a stock thinking of some type of theme, and it would play out, but not at the time that I held it in that short time frame. I'd either bought too late or sold too early or something like that. So I kind of got the direction right, but not the timing. And I think you obviously need to be an expert. You need to be in it every day to get that timing right. But it's been interesting moving from public markets. Like my previous role to Avari was actually in bonds, and so going from bonds, which is super low returns, very hard for people to understand and get their head around, and then moving into direct real estate. Essentially, it's just been a much more of an eye opener. People love real estate. Obviously in Australia, they love talking about it. Explaining a first mortgage to someone is really, really easy, whereas explaining a bond to someone is quite challenging. And the difference in returns is just light and day. So,
final question: what have you learned as a leader in that journey, and particularly in this new frontier of private?
Yep.
It's still emerging. It's still early days. What have you learned, and what do you take into the new year?
Yeah, it's a good question. I think as a leader, this is my first time actually managing a team at Avari, so that's been really good. But I think from the way I've preferred to be managed and led is where my manager is actually in the field doing, getting their hands dirty and doing what I'm doing, not just sitting there directing traffic. So that's very much what I do. I try and just lead by example and get in there and get my hands dirty and do as many calls and as many meetings as the people in your team, rather than try to sit back and expect everyone else to do it for you.
And I think there's a beauty about meeting the client, right? Because you understand the person that's investing or the developer that's borrowing what they're going through, and that ultimately makes you a better investor. Yeah,
definitely. And I love that part of it. I love doing the deals and getting, being at the front line. I think I'd be a bit bored if I was sort of sitting back in the big corner office. So, that's the way I look at it.
Well, mate, thank you very much. All the best for 2025. We wish you and Avari and all the other guys in the private credit and private equity space doing the right thing, doing good things really well. And we'll no doubt get you back through the year to get some more insights.
Yeah, that'd be great. Love to come back.
Thank you.
Thanks for having me.